This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 258, How to Set Up a Budget, Investing, Spending, and Tax Q&As. Today's episode is hosted by me, Jim Dolly. I'm an emergency physician and the founder of the White Coat Investor, as well as my co-host, Thisha Spath, an internist who is also one of our WCI ambassadors. Welcome back to the podcast, Thisha.
Thanks so much for having me.
Let's tell them about our sponsor. Have you ever considered a different way of practicing medicine? Whether you are burned out, need a change of pace, or looking to supplement your income, locum tenens might be the solution for you. Not sure where to start? Locumstory.com is a place where you can get real, unbiased answers to your questions. They answer basic questions like, what is locum tenens? To more complex questions about pay ranges, taxes, various specialties, and how locum tenens can work for you. Go to locumstory.com and get the answers. Here's the deal. If you like this podcast is totally driven by what you're interested in, right? The blog is much more so what I'm interested in writing about, but this is what you're interested in hearing about. And so a lot of this podcast is driven by your questions. And if you don't know where to leave your questions, go to speakpipe.com/whitecoatinvestor. And you can leave your questions. You can record up to a minute and a half. Don't feel like you got to fill the whole minute and a half. Sometimes we even cut them down if you get too blabby. But you can leave a question up to a minute and a half, and we will answer them, all right, on this podcast. And so that's a great way for you to participate. And the truth is, if you have a question, almost surely dozens of other white coat investors also have the question. All right, Thisha, how you been? I haven't talked to you in several weeks.
Hey.
We've been out gallivanting around on this side, but what have you been up to on the right side of the country?
Yeah, I went over to Grand Cayman Island and spoke at a women physicians conference there. That was amazing. And then I spoke at a women in toxicology conference virtually. And then in the middle there, I, did the doctoring thing full time, primary care hospitalist, and all everywhere in between. How about you?
Awesome. Well, lots of fun traveling, actually. I wedged a bunch of my shifts for this month into the very first week of the month, and then went to Canada. Had a fun ski trip to Canada.
Ooh.
We've got snow in Utah, but not nearly as much as Canada. And so that's always a fun trip. People out there say they want to hear more about our trips and vacations. And I'm like, okay, if you want to, but this was a 3-day heli skiing trip. So this would fall in the spending category of how to spend your money. And it was good fun. The weather got consistently worse throughout the trip. Which meant we couldn't fly as high and go as high in the mountains, but the snow got consistently better throughout the trip. And so that was a good time. But most recently, I just came back from San Francisco. I came back, it's Monday the 21st now. I just came in late Saturday night from San Francisco. Took my son out there this time to the CSRO conference. This is the Coalition for State Rheumatology Organizations. They've had me come out and speak, 6 or 7 years in a row to their fellows. But the interesting thing about this trip is afterward, a lot of the fellows came up and said, oh yeah, I've been listening to you for years. Oh yeah, I've been following the White Coat Investor for years. I read your book when I was, a medical student. And I'm like, why am I coming to this conference? You guys already all know about this stuff. But it was fun to hear that they'd already heard about the White Coat Investor.
That's amazing.
Yeah. All right. Let's talk about budgeting as our main subject today. Budgeting, a subject that's near and dear to your heart,
Yes.
but important for a vast number of physicians that want to be financially successful. I mean, this is like step one for so many people. And the truth about budgeting is that the hardest part is getting started. It's hard to start
Absolutely.
a budget. Keeping it going is not that hard, but starting it is hard. And we're going to talk about a lot of different ways to budget today. But the truth is that any budget is better than no budget. So do something is the takeaway message I want you to take from this. But let's talk into some of the somethings that they can do. You want to talk a little bit about that?
Yeah, Jim. So what I feel like budgeting gets really bad rap in the financial field. And, everyone wants to tell you that, hey, you can get ahead without budgeting. But the truth of the matter is that 93% of millionaires have a budget. And it doesn't have to look like everyone else's budget. There are different ways to budget. But the big thing is that when you look at the number in your bank account, for example, if you just log in and look at the number today, that tells you what you have today, but it doesn't tell you what your money needs to do. A budget is simply a plan of what your money needs to do. It helps align your spending with what you value and helps you achieve your goals, right? So it's a very practical way of achieving your goals. It's a tool in your armor, in your closet of how to get the most out of your money and achieve all of your financial goals. So why would you not use it? So,
Exactly. I
um,
think that's a totally good point.
yeah. So my thing is, I love budgeting because it gives me freedom. It gives me freedom to spend actually without guilt because I am so cheap, I would not spend otherwise. So giving me a budget, it's like, okay, I got this. There's enough money there to meet our financial goals, and here's how much you can do to spend on yourself a little bit, have fun, enjoy life. And so it gives me that freedom to spend without guilt. And it actually makes me feel wealthy and takes me out of this scarcity mindset that I tend to get into because I'm an immigrant. It helps me get out of that, gives me a raise by decreasing my unintentional spending, and then gives me a plan, right, going forward. So the goal of a budget should be to pay for all your needs, pay for most of your wants, and then, of course, meet your savings goals and your investing goals. So, Jim, I'm on my high horse. Do you mind if I just go into the types of budgets that I love?
Yeah, let's talk about the different types of budgets.
Okay.
You got to tell
So
them what kind
there's like
you use as well.
Yeah, absolutely. So the different types of budgets, when people think about budgeting, they think about like a line item or a zero based budget generally. That's the most commonly known type of budget. That's what I do, where I list out all of our spending in an Excel file, basically a Google Doc, and my husband and I go through line item by line item, each single spending category, and we put all our spending in there manually. So that's a line item budget. A zero based budget is kind of a similar thing where you're giving each dollar a job. So you make sure you account for every dollar that's coming in to your household. You account for what it's going to have to do for you that entire month. Um, there's also an older way of budgeting called the envelope budget, where you put the cash that you have and into the different spending categories manually in an envelope and carry it around with you. That's somewhat hard to do these days because nobody carries cash anymore. So that's
Not
one
to
way.
mention the mugger
But
problem.
right, exactly. And then you don't get any credit card points, which, I'm a big fan of. Um, Another way to do it when you're starting to, just want to track what you're doing, but you don't want to be tracking it every single month or day, is to do a proportional budget where you basically sit down every once in a while, every quarter or so, and make sure that your spending is aligning with a proportion that you have determined. Most of the time, it's 50%. 50% of your money goes towards your needs, like your utilities, your mortgage, your car payment, your student loan payment, the stuff that you have to pay for. 30% goes towards your wants, so like shopping, restaurant, massages, all the good stuff. And then 20% goes towards savings. So 50 to 30, 20 is the proportion that you want your spending to end up in. And every once in a while, you can do kind of a alignment check and make sure that you are spending that way. That's one way to do it. Another way to do it, and this is the least hands-on way and kind of a more automatic way for people that have plenty of income and just need to make sure that they meet their goals, is a pay yourself first or a backwards budget. Basically, all you do here is you schedule your payments, schedule your savings goals. Go ahead and schedule those withdrawals straight out of your checking account into your brokerage account, into your savings account at the beginning of the month, so that all of that is automated. You've saved and paid yourself first, and then you spend the rest. So I think of it as in choosing like which one is the right one for me. I think of it kind of in a internal medicine perspective, if you would uh, humor me for a second. So think of like a heart failure patient, right? If when their situation's super critical, they're super overloaded, they're on a vent in the ICU, you need the most amount of information then in order to turn their state around, right? You need really strict eyes and nose. You might even need a swan gans, right? I need a map right now. So this is where you need the most amount of information to turn their critical state around. So in that case, a line item or a zero-based budget in someone whose money situation is really, really critical could help them turn it around, right? You need the most amount of information. Where am I spending? Where do I need to cut back? And then as your money situation gets more and more stable, you graduate to the floor, you graduate to, going out to the bars again on a slight fluid restriction. um, you can become less and less strict about how much you're actually tracking what you're spending. You go towards a proportional budget or a pay yourself first budget. Your budget can grow with you.
Yeah, I think that's good advice. In a lot of ways, it's the whole training wheels analogy. In a lot of ways, a budget is training wheels. It teaches you the whole point of a budget, of course, is to spend less than you earn. So you can carve out
Right.
this portion of your earnings, a certain portion of your earnings, and use that to build wealth. And once you've figured out how to not spend everything you earn, you can really free up the rules around your budget and make it a little bit less work for yourself, but
Mm-hmm.
still have it fulfill its purpose of you spending less than you're earning. And once you get to a point where you are not anywhere close to spending everything you're earning, you're well on track to meeting your goals. You might need the opposite of a budget, something that forces you to spend, almost a spending budget that says you got to spend this much every month. I need to put my parents on that budget. They're going to end up leaving us way too much of an inheritance just because I can't get them to spend their money. But that's kind of where you may end up. A lot of us simply get to the point where, yeah, we kind of need to keep track of what we're spending. So we add it up once a month. We make sure we're not, the victims of fraud. We go through all the lines on our credit card statement or our bank account or whatever. But the truth is we're not anywhere close to spending what we're earning. And I call that the tracking spending budget. And it literally has one category, spending. And everything goes in that category, and then we got the big categories like taxes and charity and how much we're investing, those sorts of things. But that's basically what our budget looks like now. But it was not that many years ago when we had a zero-based budget, and that included allowances for each of us, which I think is a great addition to a budget. That prevents a lot of budget-related fights. Is if there's some certain amount of money that you can spend without having to be accountable to your partner for. What do you think are the best ways to deal with the fact that budgeting is often not a single player game?
Yeah, in my household, we make sure we sit down and budget together. My husband and I have a meeting at the end of the month where we sit down on our opposite computers and just go through the same Google Doc together. And that way, if there's any kind of spending that was like, okay, this wasn't my fun fund this month, that's where it goes, right? And we kind of talk it through. And if it's a fun category, I don't get to have any say in it. That's his fun fund, right? Or if he wants to save that, if he wants to save that for the next month, that's fine too. Most of the time, we end up not spending our fun funds, but it's really nice knowing that it's there because because it just gives you that little bit of like, okay, please enjoy yourself. You have permission because you have met your goals, and doing it together really helps us do that.
Okay. Well, take us through some of the apps. What's some of the software that's out there that can help us be better at budgeting?
Absolutely. Yeah. So Josh and I do the Excel sheet because he's a project manager and that's what he speaks like that works for him. So that's great. But there are actually lots of apps out there that will help you do this on a more automated fashion. Several of them are paid. The more sophisticated ones are paid, like YNAB, Simplify by Quicken, Every Dollar. YNAB is a favorite. It stands for You Need a Budget, and it helps you. Craft a zero-based budget where it brings in your income. You can link your credit cards into it. But the thing is, you need to go in and actually qualify each spending. Each time you spend, you have to qualify it into a category. It learns after a while, but just like any other type of budget, this isn't going to be something that's going to be like super quick. There's a learning curve to it, and it takes about 3 months to get really good at any type of budget. So YNAB is one where you're going to have to kind of invest some time upfront to watch the videos, learn how to work the software. Mint is another one. It actually brings in everything automatically as long as you link it. But you do need to know it is free, but you do need to know that they bundle your data and may sell a bundled version of your data. Um, the
Not
every
to mention
dollar
pitch you a lot of
is
other products.
yeah. Yeah, there's a lot of pitching going on in any free product, right?
Yeah,
Same thing with personal
you are the
capital.
product with Mint for sure. Yeah, you're the
Yeah.
product.
Yeah, and personal capital, the call that you get, I think is at $200,000 worth of net worth, where once you link your accounts and you reach a certain net worth, they start calling you to try to sell you their advising services, which is really kind of it's a nice goal to get to, to aim for that. We were aiming for that when we were starting out, like, hey, we got the personal capital call. So that one's free as well, and it will pull in your data. It does help you budget, and it does help you like balance out your portfolios and look at your asset allocations and gives you automated advice through that as well. So there's every dollar that is the Dave Ramsey version of the app to budget. Again, it's a zero-based budget. It's a little bit less sophisticated when it comes to credit cards, since Dave kind of tends to preach against credit cards in general. But the credit card payments and kind of get lost in that app. Where YNAB I think tracks that a little bit better, but every dollar does have it's a little bit more intuitive to deal with interface wise. So it might work for some. They also have some free videos that you can watch about budgeting and a trial period, so you can always try it out. Um, Simplify is a little bit cheaper. I think it's $4 versus like $10 to $11 of YNAB and every dollar per month, and that's by Quicken. That works for some people. And finally, Emma. Things like there are there's other smaller apps. Emma I thought was good for just it goes through your spending and it looks at all your subscriptions and it brings it up for you to see and decide whether this is something you want to continue to subscribe to or not. In this day and age, that's a very easy way to start losing money out of your account. So that's a good one for that. And then finally, Excel. Excel is not an app, but it will definitely help you devise a budget. So those are the ones that I know of, Jim.
Yeah, for sure. I mean, Excel is what we've been using for years and years and years. But I mean, you can do this with paper and pencil if you want. It's not complicated. It's only third grade math at most.
Right.
So it's not like you need a super powerful thing. You need what you're going to use. Whatever you're going to use is what's going to work for you. If you want to learn more about YNAB, podcast 167, we had Jesse Meekum on. He's the
Oh
CEO
yeah.
of YNAB. I've known him for many years. The company's located here, not far from WCI headquarters. And so if you want to hear more about where that app came from and how they run their business, you can go listen to that. I actually have a neighbor who had me help them apply to work at YNAB not long ago, and so it's a great company. I have a lot of
Awesome.
respect for Jesse and what he's doing there. But it's not free. You got to pay a monthly fee to use it. So keep that in mind.
Yeah, I
All right,
know.
I think
I know a lot of people that love it.
yeah, let's wrap up that and go into the first question, which I think is actually related to budgeting. So let's listen to this question from David, and see what we can help David with.
Hi, Jim. This is David from the Midwest. I'm calling on the topic of how an early career physician should think about their income over the course of their career, especially as I'm trying to determine what I can reliably spend over the course of my earning time. I'm in a high-paying specialty and above the median for that specialty as well. And so I'm just wondering how you think that an early career physician should expect their income to be over the course of their career. Do you think we should expect it to go up, down, relatively stay the same, keep up with inflation? Have you become aware of certain specialties that are vulnerable to significant income decline over the course of their career? So for me specifically, I'm an oncologist, so a lot of my reimbursement comes through high reimbursing chemotherapies, for example. So what happens if all of a sudden the government decides that chemotherapy is only going to reimburse half, So how do you protect yourself, or how do you plan for the potentials in income variability over your career? Thanks.
All right, great question, David. You want to take a shot at this one, Thisha?
Well, so cost of living adjustments are generally not built into a physician contract, but having noticed what my salary has done for the last few years, I mean, every time I get a new contract, it's certainly higher. The median pay for doctors is generally trending up. However, I wouldn't count on it. I am a firm believer in living below your means, and I would definitely learn how to live within the means that you have now, as this attending salary, the first attending salary that you have, and then use the rest as just extra gravy to help you fuel and meet your goals.
Yeah, I think this is highly variable. It varies a lot by type of job. It varies a lot by specialty.
Hmm.
For example, in emergency medicine, if you're a partner, you start out relatively low pay on a pre-partnership track, and then you make partner after 2 or 3 years. And once you make partner, you are basically at peak earnings. That's it. That's as much as you're ever going to make. Because chances are you're never going to work more shifts, and you're never going to work more undesirable shifts, i.e., night shifts that pay the most, than you are right then in your career. So for most emergency docs, at least on an inflation adjusted basis, you should probably plan on earning less and less throughout your career versus what you're making, within a couple of years of getting out of training. Now, that's not necessarily the case for somebody else that's building a practice. If you're building a practice, you're building a rheumatology practice, for instance, and you just go out into private practice, it may be really slow going in the beginning. Maybe an ophthalmology practice if you're a sole practitioner, and as you build up your panel of patients, your income goes up. If you're on like what's it called, Doctors for Patient Care, like some sort of concierge practice, as you build that practice, your income's going to get higher. And so you gotta adjust this to how you're doing it. If you're just an employee, like I don't know what it is now, 70% of docs maybe now are employees. And then you can kind of expect to be able to negotiate raises that at least keep up with inflation as you go along. But there's lots of risks in every field. Like it wasn't that long ago that radiologists as well as cardiologists both took significant cuts. And what was it from? It was just from the reimbursement for something they did a lot in their specialty being cut. Got cut by Medicare and then ended up being cut by the private insurance companies. And all of a sudden, there was just less money there to pay them. So if they were in any sort of private practice at all, it meant they were being paid less. Even if they were an employee, it meant they were generating less and viewed as less valuable to the organization, and so maybe paid less. And so something like that can certainly happen to your specialty. Now, you bring up oncology specifically, where a lot of the income's from the drugs. And so there's serious risk there for you to end up making less money down the road. It's no guarantee, of course. So what can you do about it? Well, not much. I mean, you make as much as you can, as is reasonable. You negotiate as best you can. You try to run your practice as efficiently as you can. But some of those forces are out of your control. So there's not really any point to worrying about them. As far as your personal budget goes, you try to make hay while the sun's shining, and get your financial ducks in a row. So in case something does happen to it, you can adjust. What's it like in internal medicine, do you think? In general, should people expect to be paid more each year throughout their career? Or do you think it decreases because people work less or take less call? Or what do you think the usual flow is?
Yeah, it's difficult to get a raise where you are currently working unless you go from something like, pre-partner track to partner track, or your Um, earnings goes up, but just because you're working more and seeing more patients. Generally, I found it's easiest to get a raise when you change jobs. So every time I change jobs, I definitely get a um, higher offer. But yeah, it's very difficult to negotiate that from an employee perspective when you're not changing, positions.
All right. Thanks for sharing that. I know this is a tough question, but you do the best you can. All right, let's do our quote of the day today. These quotes actually come from Jesse Meekum, the founder of You Need a Budget. The first one is budgeting is not dieting, it's planning. And I think that's very true. You got to realize this is not something that is hurting your ability to spend. It's improving your ability to spend.
Absolutely.
And the second is that budgeting is not spending less. It's spending guiltless.
I love that.
I like that quote a lot.
That's awesome.
Okay, our next question is from Diana, who's talking about the taxes on taxable accounts and how they work. So let's take a listen to that.
Hi, Dr. Dolly. I have a question that's probably kind of dumb, but if you will indulge me, regarding taxable accounts. How often and when are we actually taxed? So, for example, if you have 500 shares of like BTI in a Vanguard account, are you taxed capital gains only when you withdraw it? Are you taxed annually? Are you taxed on shares that are sold and bought within the ETF? So quarterly? I'm trying to understand. It seems to me that probably you'll have to pay some capital gains periodically, even if you don't sell the shares. Do I understand that correctly? Or can I buy a bunch of shares of an ETF, leave it there for years and years, and I only pay when I sell it? I'm sort of confused about that. If you could dumb it down for me, I would really appreciate it. Thanks so much.
Great question, Diana. I like this question a lot. It's important to start, however, from the perspective that this is not a bank account. Okay, it's not about withdrawing money from the account. Within this account, you own stuff. And when that stuff does something, or when you do something to that stuff in that account, taxes generally result. Thisha, you want to run us through the various taxes that people pay on investments?
Okay, so we're talking about a brokerage account. In a brokerage account, you pay taxes in several different ways. First time you might trigger taxes is capital gains. So that's the difference between the sale price and the cost basis, or what you paid for it. If you sell your share, your stock or your bond, and within a year of buying it, that's subject to short-term capital gains, and that's taxed at your ordinary income. So all the way up to 39.6%. So we try to avoid that as much as possible.
37% these days.
Yeah, right. And long-term taxes, capital gains taxes are a lot more favorable to you. If you sell after a year from buying the equity, then you're taxed at a more favorable 15%, usually at most. There's an exception. If you earn less than 80K married, then you would be at 0% capital gains tax. Or if you earn more than about 500K married, then you would pay 20%. Again, that's usually much less than your ordinary income tax. So long-term capital gains tax is kind of what we aim for if we have to take the equity out or sell it at some point. Another point you might get taxed is when your stock pays out dividends. So dividends are when their payments made from the business to its shareholders that have invested in it. And this happens periodically. Generally, if in most index funds you have qualified dividends, so these are dividends that have gotten permission from the IRS to be taxed at long-term rates, so the more favorable rates. So qualified dividends are preferable. Ordinary dividends are taxed at short-term or your ordinary income tax rate. Another time you might get taxed is when your money earns interest. So interest in any account, savings, money market account, money market income is taxed at your ordinary income. And finally, if you own mutual funds that are actively managed, then whenever those active managers do trades and sell something, those capital gains from that, the sale of the equity in that fund, are passed on to the investors. So that's something that you need to know if you own mutual funds.
Yeah, you got to be careful about that. I mean, in a lot of ways, the mutual funds can burn you. you can actually lose money in a mutual fund and have them send you capital gains that you have to pay taxes on. And so the more actively managed the mutual fund, the more you do not want it in a taxable account, because it can really, really burn you that way. The other thing to keep in mind, if you're a relatively high earner, more than 200 single, more than 250 married, you also got to pay Obamacare taxes on your investments. And so that's an additional tax that you have to pay of, 3.8%, I think, 3.6, 3.8, one of those two. Don't quote me on it. But you got to pay on every capital gains, every qualified dividend, etc. And also, here's another pearl. If you are into tax loss harvesting, which is trying to get tax losses, right, to use to offset your capital gains, be advised that if you do not hold an investment for at least 60 days around the time a dividend is paid, that dividend becomes non-qualified, and you pay ordinary income tax rates on it rather than the lower qualified dividend rate on it. So I've gotten burned on that before. You got to be a little bit careful with that when you're doing tax loss harvesting, especially.
That's good to know.
Oh, one other thing. She's asking about, when do you actually pay these taxes? Now, our tax system, our federal tax system anyway, and many state tax systems are pay as you go. So you're supposed to pay as you go along. If you realize a big, huge capital gain in February, you're supposed to pay that in the first quarter of the year. Now, a lot of people are not having big, huge capital gains, and they can just cover all the taxes they owe by having money withheld from their paychecks. But if you are having to make quarterly estimated tax payments, and you make a lot more money in early in the year, you're supposed to pay taxes on that money when it comes in. So you got to be careful about that. You may end up getting some tax penalties if you don't do that. But for most people, for relatively small capital gains, that's not a big deal. You can just settle it up basically the next April when your tax return goes in. All right, we got to tell you about something here. We've got a great opportunity. If you are interested in passive real estate, we're talking syndications, we're talking funds, but you do not know how to evaluate them. You do not know the ins and outs of them. You're interested, but you just feel like you can't tread in there because you're not sure who's going to rip you off, who isn't, and what you're doing. There is a course out there put together by my friend Peter Kim at Passive Income MD called Passive Real Estate Academy. Okay, PREA it's called, and that's what the URL is if you're interested in more information about this online course and online community. If you go to whitecoatinvestor.com/PREA, you can get more details on that. You can get enrolled in that class. Like all the online courses we tend to do here at the White Coat Investor, there's a money-back guarantee that you can take a peek and try it before you buy it and check it out and make sure that this is something you actually want, because like most of these courses, it's not super cheap. It's only something you ought to be buying if you're really interested in doing this, but it will take you by the hand and walk you through what you need to know to invest in passive real estate. Again, whitecoatinvestor.com/PREA. All right, let's talk about Vanguard and the retirement funds with this question from Jason.
Hey, Dr. Dolly, longtime follower, and thank you for all that you do. I just had a question about the recent situation that happened with Vanguard and the target date retirement funds. Apparently, they lowered the minimum requirement from 100 million down to 5 million in their institutional share class of this target date retirement fund. This eventually triggered a bunch of capital gains distributions unknowingly to a lot of retail investors in this same fund in their taxable brokerage account. My question is, what would make Vanguard not do something like this in, say, just a regular total U.S. stock market fund? Could they lower their minimum requirements for the institutional share of a total U.S. market fund, causing the same type of capital gains distribution for their retail fund? And would this make more sense now for everyone to use ETFs in their taxable brokerage account? Thank you for your answer and look forward to hearing from you.
It's a great question, Jason. Yes, there is some protection here when you are in a fund that provides an ETF share class of the fund. Because what they can do is they can take those appreciated shares and they can distribute it to these ETF creators out there, and they can pass on these appreciated shares to them rather than, basically dumping that sort of a thing on the small investors. So there is some risk of that happening with any fund, right? If they changed and allowed those of us that have, let's say $500,000 in the fund to now access the institutional level fund and save 2 basis points a year. Many of us who owned that share in a retirement account would sell our shares and go buy the now lower expense ratio version of the fund. Now, nobody's going to do that in their taxable account because they're going to realize those gains themselves. But if you're working in a retirement account, that would be certainly something that would be tempting to do. And those who are left behind in the fund, who are in a taxable account, could get hosed by it. That absolutely is a risk. I think it's lower with the typical Vanguard index funds that we all tend to use, especially if they have an ETF share class, than it was with the target retirement funds, which I think are pretty much designed to be put into 401ks. They're designed to be inside retirement accounts. So I think the risk there was a lot higher. And that's why people have been saying, don't own these things in a taxable account for many, many years. And now you see yet another reason why that's maybe not such a great idea. By the way, as an update on that, there is a class action lawsuit going. If you were affected by this, there's an attorney out there. If you go to the blog post I had on this, I think it was the first week of February, there are links there if you're interested in getting involved in that. I have no idea if they're going to win. I've heard from a lot of lawyers that say there really is no case here, and that may be the case. But whether there is or isn't, those of us who are owners of Vanguard by owning their funds are going to be paying to defend against that lawsuit, which is kind of a bummer for all of us. But if they would just not do things like that they really didn't have to do, they wouldn't have this problem.
Well,
All right, next question. You go ahead.
Oh, I was going to say, this just nicely ties into the last question we had about how we are taxed in a taxable brokerage account, and how the taxes from mutual funds, actively managed mutual funds, any activity in there gets passed on to the investor. So I love that it all ties in together, and just understanding the basics pays off for you in the end.
Yeah, exactly. Jason gave a good explanation of what happened, but basically, Vanguard said those of you who want into these lower cost funds can get in there now with a lower minimum investment. So a bunch of 401ks and pensions basically said, sure, we'll take the lower expense ratio. And when they did that, they sold their shares. And so what did Vanguard had to do? They had to sell a bunch of shares of stock that are in that fund. And so what happens with the capital gains from those shares? They got to be passed on to the remaining investors. So the remaining investors, which in this case turned out to be the small investors, were left holding the bag, which was a dirty trick, I thought, from Vanguard. All right, next question from David. Let's take a listen to that.
Jim, this is David, I'm a retired ER doc from California. 2 questions. Number 1, what are your thoughts about the QQQ, or the Invesco 100, which invests in the NASDAQ 100, as a way to get a piece of the exponential technology sector? And number 2, with the Fed's likely to increase interest rates several times this year, what are your thoughts about switching your bond funds into money market funds and then harvesting the tax losses, at least in your personal accounts? Thank you very much.
Okay, so the QQQ tracks the NASDAQ 100 index. So basically, this is a large cap tech company index fund. You have Apple, Amazon, Meta. So you get a lot of high sector risks because you're basically in one sector, and no small cap, so you don't have that much growth potential. Expense ratio 0.2%. 0.2%. The fact that these are all large tech companies, you have a really high bear market risk, because these companies tend to have a lot of swing and variation depending on the market. Would I go for it now? Probably not, because I try not to forecast the market, but it's looking pretty bearish recently. I don't know. What do you think, Jim?
I don't like this investment for several reasons. One, it's a sector fund. Right? It's a sector fund masquerading as a broad index fund. This is not a broad index fund.
No.
The stuff that trades on the NASDAQ tends to be very, very tech heavy. This is a tech fund. So if your written investing plan calls for you to own a tech fund, maybe you have 5% of your portfolio in a tech fund or something, then, sure, this is something maybe you ought to consider to fill that allocation. It wouldn't be my first choice, even for a tech fund, though. I think Vanguard's got a tech fund that I like better than the QQQ. And so, but that's what it is. This is not, you shouldn't compare this to a total stock market index fund or even an S&P 500 index fund. These are not the same things, right? The 500 index fund invests all across the broad market. The NASDAQ 100 does not. The other thing to keep in mind is you already own an awful lot of tech these days. Have you looked at the top 10 holdings of a broad index fund, like a total stock market index fund? Guess what it is? It's
Mostly
Apple
these guys.
and Amazon and Meta. This is what it is. And so you're kind of doubling down your bets on these big, large growth tech companies. So not a huge fan. I don't tilt my portfolio toward tech. If you want to, maybe consider this fund for a small percentage of your portfolio, but this isn't a favorite fund of mine. Just because people have heard of the NASDAQ is why they end up investing in it. And there's lots of ads for QQQ out there. But this is not something I invest in or ever plan to invest in. So I think it's a little bit more of an investment designed to be sold, really. The other question I find more interesting, and unfortunately it requires a crystal ball to answer, right? Should you sell your bonds and go to cash? Well, do you know how bonds are going to perform compared to cash over the next year? Right? Now, this assumption that because the Fed has said they're cutting interest rates, that cash must outperform bonds, the market already knows the Fed has said it's going to cut interest rates. So there is no guarantee that money market funds are going to outperform bonds. They may or they may not. But what I do in these situations is I try to set up my investing plan so I don't have to have a clear crystal ball in order to be successful. And so I set this up way back in residency. Right? We have 60% stocks, 20% bonds, 20% real estate. That's our investing plan. And so if I think bonds are going to do poorly, I don't switch all the bonds to cash. And when I think bonds are going to do great, I don't switch all my stocks to bonds. I think that's a recipe for chasing your tail, incurring a lot more capital gains taxes that we talked about earlier. I just don't think it's a great idea. Now, if I had to sit here and predict which one of those is going to win this year, I'd probably flip a coin because I'm really not sure if bonds will outperform money market funds or not, right? Rates are supposed to go up, and they probably will go up, but really the market ought to be pricing an awful lot of that information into the price of its investments already. All right, let's take our next one. This one is a question for military docs, I think.
This is Aaron. I am a military orthopedic surgeon who will be separating from the military this summer. I took advantage of the blended retirement system and have been investing in a Roth IRA. And I was hoping to get your opinion on what to do with those funds after I separate from the military. Should I keep them with TSP? Should I roll them over? Any guidance would be greatly appreciated. Thanks for your time.
Great question. Your real question here is what do you do with your TSP money when you leave the military? Obviously, with the new BRS system, you get to leave with something you didn't used to get. When I was in, you didn't get a match on your 401k, your military 401k, aka the Thrift Savings Plan or TSP. You just got the money you put in there. So that's all I left the military with was the money I put in my TSP. You had to stay 20 years to get anything else, to actually get a pension from the military. Now you get that match. You get to take it with you if you leave early. But it's basically just like the money you put in the TSP. So the question is, do you keep the TSP or not? Now, when I left the military, I kept the TSP for a couple of reasons. One, at the time, it was the low-cost leader. It was the lowest expense ratio 401k out there. You got all these mutual funds at 1 or 2 basis points, and the other thing you got the special G fund, which the G fund gives you basically bond returns at money market risk. And so that's kind of a cool fund I've used as a significant holding in my portfolio ever since. The downside is I've had to manage another retirement account throughout my career. So it makes my portfolio a little more complex. So you can leave it there for now. If you decide after a while it's not worth it to you to have the G fund and you look around, you're like, man, Schwab and Fidelity and Vanguard, they all have stuff that's just as cheap as the TSP these days. Maybe I'll just roll this into, my Roth IRA, or I'll roll it into my current 401k or whatever, then I think that's fine to do. But there's no rush to get it out of the TSP. I mean, I left the military in 2010. My money's still in the TSP. I've actually done several rollovers into the TSP. So I wouldn't feel like you need to get the money out of there. One reason you might definitely want to take it out is if you have a bunch of after-tax money in there that you put in while you were deployed. It makes it a lot easier to roll that into a Roth IRA. And no longer have after-tax money earning taxable, income on it. When you take that after-tax money out, all the earnings come out as tax-deferred money, and you have to pay taxes on them. But if you get that into a true Roth account, you don't have that problem. So that might be one reason to roll it over into a Roth IRA. But I wouldn't feel like there's some huge rush when you get out of the military to do something with your TSP. You can take your time and decide in a few months what you want to do.
Awesome.
All right, so let's talk about 457s.
Hi, Dr. Dolly. This is Nick from North Carolina. I appreciate everything that you do. My wife and I are both physicians for the same hospital system, and we both max out our 403 and 457 retirement accounts. Recently, with the spike of Omicron, they have requested that we delay spending our CME money, and it was extended, which didn't make sense because they're starting up elective procedures. At what point would you jump ship on the 457, or is there anybody you would talk to, or any certain things you would look for where you would not think that the hospital is stable? They've all said in the emails that we're financially stable, but they just ended a merger too, which didn't make financial sense if they were stable. So I appreciate your help on this. Thank you.
So that's all sounding pretty shady. First of all, I'm assuming this is not a governmental 457, that this is a private 457. If it was governmental, you might be able to roll it over to a next employer. Since it is not, which is what I'm assuming, I would definitely start looking into the withdrawal options that you actually have with this 457. Since you're both working at the hospital, you are, you're taking more than the usual risk. I would start asking some questions and just knowing what my options are at this point. What do you think, Jim?
Yeah, I mean, my usual answer on these, I've never met a doc who lost 457 money. If there is somebody out there and you've lost 457 money because the hospital went under, shoot me an email, editor@whitecoatinvestor.com. I'd like to hear about it. I've yet to hear about any doctor ever losing their 457 money. But I agree, this sounds really bad. When they're telling you don't spend your CME money, I mean, that's part of your salary, really. That's sketch.
That's pretty bad.
Maybe they're not doing very well. So I might dial back what's going in the 457. Because remember, there's three things that matter with the 457. One, this is non-governmental, of course. One is the investments and fees. If they're reasonable, great. Two is your distribution options. You don't want to have to take it all out in the year you leave the employer. That's a bad distribution option. If you can take it over 10 years or delay it till you're 65, that's fine. And the last one is the hospital stability. Because remember, it's not your money. This is deferred compensation. It's still the hospital's money, and it's subject to their creditors. So if they go bankrupt, you could theoretically lose your 457 money. And boy, in what you're describing, I guess I would worry about that. It doesn't sound very good at all. All right, so let's take a moment to thank our listeners out there. Some of you on your way home from work, maybe you're on your way into work, or maybe you're coming in on a call, whatever it might be. Thanks for what you're doing. It's not easy work that you do. As we heard last week on the podcast, we had a guest on that shared a video she'd made. This is last week from the time we're recording this, of course. It's probably 6 weeks ago by the time you're listening to this. There are people out there with PTSD from their jobs, caring for other people. It's not easy work. And so if nobody said thanks today, let us be the first. Thanks for what you do.
Thank you.
All right. Let's take a question on TurboTax. I don't claim to be a TurboTax expert, but let's see if we can answer this question.
My question concerns Form 1116 Schedule B, Foreign Tax Carryover Reconciliation Schedule, and TurboTax's lack of support for e-filing returns with this form. Situation. I'm a longtime user of TurboTax and e-file my return. I've completed my 2021 tax returns and am ready to file. However, TurboTax says it is not supporting e-filing of Form 1116 Schedule B, Foreign Tax Carryover Schedule. My taxes are rather simple, yet, as part of my asset allocation, I own funds that generate foreign dividend and income. Foreign taxes are collected at the mutual fund/ETF level, thus I need to file Form 1116 and Form 1116 Schedule B. I suspect that many of your listeners, who follow an asset allocation strategy that includes international funds, may also run into this situation. Question. Since TurboTax has taken the position that it's not supporting e-filing of 2021 tax returns that include Form 1116 Schedule B, I'm in need of a tax software package that will allow me to e-file. Please recommend an alternative to TurboTax.
Thank you, Jake, for that question. All right. I appreciate your desire for anonymity. If you choose to use an electronic voice on the SpeakPipe, maybe at least have it go at like regular speed, I think, because there's a lot of people out there already listening to this podcast at 2x speed. So that question was probably at 4x speed for them. I don't know. But this is a question on TurboTax. Thisha did some research on this. I don't think either one of us knew the answer to this question going into it.
No.
But share what you found, Thisha.
Yeah, so I went into the TurboTax Q&A, and it seems that the problem has been fixed. It seemed to be a software update issue. But I'm looking at a thread back and forth between the TurboTax people and someone else asking the same question. And it seems that as of yesterday, the IRS accepted this person's return, and the Form 1116 Schedule B did go through. So that should be fixed for you now. I don't work for TurboTax, but I'm just looking online, and this is what I found. So hopefully
Awesome.
This is an
Thanks
old
for
question.
looking that up.
Yeah, no problem.
Yeah. I mean, there's a little delay between people leaving when people leave stuff on the SpeakPipe and when we get it on the podcast. So hopefully this has been resolved at this point. But boy, that was one of the more challenging questions I think we've gotten over the years, for sure. Hey, it's April. We're trying to give away some money. And the money we're trying to give away is to people who are educating their peers, colleagues, trainees about finances. So if you're a practicing doctor or dentist, or better yet, if you know somebody that's a practicing doctor or dentist and is educating their peers on finances, giving lectures, putting together curriculums, publishing papers, whatever, we want you to nominate them for our Financial Educator Award. Okay. You can do that at whitecoatinvestor.com/educator. And it's a short, quick, easy nomination form. And then at the end of this month, we'll be choosing the winner of that. We'll be publicizing it on the blog, but we've done this for the last several years. Some of the biggest names in physician financial education have won this award. You can't be a blogger, a podcaster, or a financial advisor, right? Practicing doc, dentist, physician. I suppose if you were a veterinarian or something, we'd consider you for the award as well. But you got to be educating your high-income peers about finances, and you can't nominate yourself. Someone else has to nominate you. But we give you a nice award and $1,000 cash if you win this. So please nominate people if you would, and we'd love to give away some money. All right, a word from our sponsor. Have you ever considered a different way of practicing medicine? Whether you're burned out, need a change of pace, or looking to supplement your income, locum tenens might be the solution for you. Not sure where to start? Locumstory.com is a place where you can get real, unbiased answers to your questions. They answer basic questions like what is locum tenens, to more complex questions about pay ranges, taxes, various specialties, and how locum tenens can work for you. Go to locumstory.com and get the answers today. All right. Thanks to those of you leaving us a 5-star review and telling your friends about the podcast. Our most recent 5-star review mentions Thisha, so I'm going to make you tell them about it.
Well, thank you so much. I really appreciate it. It says, if you're a high-income earner, there's no better place to start and maintain financial literacy. I started from knowing nothing to feeling quite competent just by listening to the podcast alone. Also, recently they added Dr. Spath as a co-host, and she has been a great addition to the team. Thank you again, guys. I really appreciate the positive feedback, and please keep it coming. If it's negative, send me an email, thisha@whitecoatinvestor.com. I'd love to hear from you. Thanks so much.
Yeah, we do appreciate negative feedback in private and positive feedback in public, like everybody else out there. It's been fun having you on here again, Thisha. And until next time, those of you out there in listener land, keep your head up, your shoulders back. You've got this, and we can help. We'll see you next time on the podcast.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.